Hey guys, what's up? Hello everyone. Hi everyone. So I'm your educator, Ayussh Sanghi. We have been doing the NCERT, basics of NCERT of class 12. We had started with class 12 part 2 NCERT macroeconomics. If you remember, we have started with macroeconomics. We have completed the first chapter. We had completed the second chapter yesterday and started with the third chapter. So it's going pretty well. I hope it's benefiting you in a proper fashion. You have to revise these lectures. Along with this, wherever you can practice from, you can practice MCQs as well. All right. So, guys, let's continue with chapter number 3. I repeat, let's continue with chapter number 3. We are talking about we're talking about the NCRTs. All right. So let's start. Yesterday we were doing things about money. So let me just show it to you. We had started with this chapter. The name of the chapter is Money and Banking. It's Money and Banking. Introduction to Macroeconomics, Money and Banking. I had explained to you what money is. This is chapter 3 presented by me. We had discussed what exactly money is. So the definition of money, I'm revisiting what we did yesterday. Then we'll continue from where we left off with detailed explanations. All right. So money is an officially issued legal tender and a commonly accepted medium of exchange. Officially issued legal tender. Legal tender which is officially issued. It has been officially sanctioned by the Government of India and has been printed by the Reserve Bank of India, and a commonly accepted medium of exchange, usually in the form of coins and banknotes. So it's usually in the form of coins, as have been given on the left, and banknotes, as have been given on the right. It is also known as currency, and it is a medium of exchange. Money, cash, is considered to be the most liquid asset. I repeat, money or cash is considered to be the most liquid asset. This is what money is. Then we had discussed the definition of what a legal tender means: a medium of payment recognized by a legal system to be valid for meeting a financial obligation. Anything which is declared as legal tender by the state, by the establishment, by the authority, by the government, by whatever name you may call it, if it has been declared as a legal tender or as a legally acceptable thing, then that is considered to be a legal tender. A medium of payment recognized by a legal system to be valid for meeting a financial obligation. This is something that we had discussed. Liquidity is the degree to which an asset or security can be quickly bought or sold in the market without affecting the asset's price. So, asset price is not affected. Liquidity. Liquidity is what? Liquid. One has to be liquid. Liquid means how liquid is the thing that you have with you. That is liquidity. After this, I had discussed the functions of money. So, what are the various functions of money? The various functions of money are it acts as a medium of exchange. We had discussed this in detail, and we had seen as to how this thing is important. It is acting as a medium of as a medium of exchange. This is the first function. Followed by this, the second is, or rather, within the medium of exchange, it is double coincidence of wants. Double coincidence of wants, when we talk about barter system, this is the disadvantage of barter system, that whatever I am willing to give, the other person is willing to accept the same, and whatever I want, the other person has the same. It is considered to be double coincidence of wants, right? So the first thing that we have discussed is it acts as a medium of exchange. Followed by that, the second thing is it is acting as a unit of account or measure of value. Unit of account or measure of value. Unit of account or measure of value means that it would be denominated. Anything can be denominated in terms of money. For example, unit of account. I am buying these many units for as much. for rupees. Let's say I am buying this phone, a cell phone for worth 20,000 rupees, and a bed is worth rupees 5,000. We can say that cell phone is worth 4 such beds. So one cell phone is worth 4 such beds. This is what we have discussed in this unit of account or measure of value. So unit of account or measure of value has been included within this. This is the second function of money. The third is store of value or saving. Store of value. Store of value means it is storing things of value, or you can even save it. You can save the money, or you can store it of value. Saving means storing money in lockers, storing the money in lockers, banks, so that it can be used in the future. You can use the money in the future, you can use it as a part of the locker and banks. This is what savings mean. And these are the things that would give us certain things. Like for example, there are things that you can store. If you have gotten 10,000 rupees, you can store it. You can store it in a locker. You can even put it in your savings account. There are two drawbacks in savings commodities. Two drawbacks in savings commodities. The first one being cost would be enormous. The various costs are enormous. If you continue doing the barter system, where you would have to save commodities, the cost would be enormous. The cost would be very high. So storing cows or wheat instead of money, this is something that would lead to enormous cost. And plus they are perishable items, which is the second drawback. Commodities are perishable. So how can you store wheat for future use if it perishes in 4 months? How can you store wheat for future use if it perishes in 4 months? Cost would be enormous, commodities are perishable. These are the two drawbacks. So store of value or savings, these are the things that we have as a part of savings. Store of value, savings, the third function. The fourth is money can be used as a standard of deferred payments. Payments can be deferred. So if you have bought something today, you can go on paying for that particular commodity over a period of time, over a period of 12 months, 24 months, 48, whatever, 48 months. So it is a standard of deferred payments. Deferred payments are payments which are made sometime in the future. Whatever are deferred payments, they are payments which are made sometime in the future. So you can defer payments only if it is denominated in the form of money. I repeat, the payments can be deferred if they are denominated in the form of money. So standard of deferred payments, they are realized, they are given over here. So that is something that we had discussed. Then the third part was demand of money. One is demanding money. Demand of money, whatever money we demand. So we have already learned the money is most liquid asset as it is universally acceptable and can be exchanged for other commodities very easily. So it is universally acceptable that everybody accepts money. This is also a disadvantage of barter system, that not everyone would be willing to accept your goods and services. So universally acceptable money and can be exchanged for other commodities very easily. If that is the case, then everyone should hold all their money with themselves all the time. So demand of money is that money is the most liquid asset. It is true, money is the most liquid asset. And it is universally acceptable and can be exchanged for other commodities very easily. So the point is that if you try to hold all your money with you, that results into a huge opportunity cost. Reason being that the value of money would depreciate. The value of money would go down. So there is an opportunity cost in holding money. So we could have earned interest on the amount if we had put the money in bank. Hence, yes, money is the most liquid asset. You should have as much money in your hands to be able to meet out the liquidity requirement, but not much money. That is something that is stated. So the pro is it is the most liquid asset, and the con is the opportunity cost is high, demand of money. The trade-off between the advantage of liquidity and the disadvantage of foregone interest is seen in terms of demand of money. There are three motives when we talk in terms of liquidity preference. Three motives. Liquidity preference. So what is the preference of liquidity? Let's have a look. The first preference of liquidity is, the first thing is, first motive is, I would say, transaction motive. Transaction motive means that you are carrying out transactions. Transactions are being carried out. Primary motive for holding money is to carry out transactions. Transactions means purchase and sale. If I have to purchase something, if I have to sell something, I would be able to carry out transactions. Primary motive. Simple reason I would want to hold money would be because I want to do monetary transactions. I would want to buy stuff. I want to conduct monetary transactions, which is why I would buy money. Transaction motive. Followed by that, the second is precautionary motive, to have money, liquidity in emergency situations. So it is a demand for holding money in its most liquid form in order to be prepared for emergency situations. Precautionary motive. And the third is speculative motive, holding of money for the purposes of avoiding capital loss from holding bonds or stocks. So if I hold bonds or stocks, it may result into loss of capital, it may result into loss of money or loss in value of those stocks or bonds. So it's better to hold money. So hold money in the form of cash. It arises from uncertainties about the money value of other assets that an individual can hold. Speculative motive. So speculative motive, precautionary motive, transaction motive. These are three motives because of which money is kept in that particular form. We had discussed this yesterday. Yes. Supply of money. Supply of money, so demand of money is such that you are being able to demand, you are demanding money because you have to, because of these motives, transaction motive and all these motives, the three motives on the basis of which people hold on to the money. Now we read about the supply of money. Supply of money, the first thing that we had discussed yesterday was agencies responsible for printing money. The sole agency responsible for printing money is the Reserve Bank of India. Currency notes are printed by the Reserve Bank of India, Section 22 of the RBI Act 1934. Section 22 of the Reserve Bank of India Act 1934 gives the bank the authority to issue currency notes. So it is issuing currency notes, the bank the authority to issue currency notes. Agency is responsible for printing money. It is the Reserve Bank of India. Remember this. Followed by that, the important terms associated with money. The first term that we had discussed yesterday was fiat money. Fiat. Fiat means an order of the government. And on the basis of order of that government, money is provided the designation to be broadly, universally acceptable. So what is it? It can be declared as legal tender. I repeat, it can be declared as legal tender. Legal tender, if money is declared, then that money has to be acceptable by the person in terms of trade, whenever any trade is to be done. It is not backed by a physical commodity. The value of fiat money is derived from the relationship between supply and demand, rather than the value of the material that the money is made of. So, intrinsic value was something that erstwhile was there when there was the Mughal rule. At that time, the kingdoms used to trade in specific, you can say, coins made of metal and made of precious metal. So that had intrinsic value. But this does not have intrinsic value. We are talking about fiat money. Followed by that, the second is legal tender. We had discussed the definition of legal tender yesterday. I would repeat it once today. Legal tender means that the specific currency has been provided that aspect. It has been provided specific thing on the basis of legal tender, on the basis of legality. Coins, notes, or other instruments that are legally recognized as a medium of exchange. Coins, notes, other instruments, they are legally recognized as a medium of exchange. Legal recognition as a medium of exchange. Legal recognition is granted by the government of India. Legal recognition is granted by, you can say, legal recognition is granted by the government of India, and that is something which is applicable by the Reserve Bank of India. So it is legally recognized as a medium of exchange. The national currency is a legal tender in practically every country, and it can only be issued by the central bank, Reserve Bank of India, RBI in India. So national currency is legal tender in practically every country, and it can only be issued by the central bank, RBI in India. So this is something which is considered to be legal tender. There have been multiple instances where we have seen that there is only as much, or there is only so much of the currency that you recognize. So there were erstwhile notes in the denomination of 500 and 1000. Why did those notes become, you can say, worthless? for the simple reason that they were no longer a legal tender, and it can only be issued by the central bank, Reserve Bank of India. They cannot be refused by any citizen for settlement of any kind of transaction. You cannot refuse saying that I don't accept this of money. Legal, kanuni definition of money. There is no unique definition of money, either as a concept in economic theory or as measured in practice. Either as concept in economic theory or as measured in practice, but in order to bring in objectivity, money has to be defined. So in order to bring in objectivity, money has to be defined. We already know that the total stock of money in circulation among the public at a particular point of time is the supply of money. So total stock of money in circulation, all the stock of money in circulation among the public at a particular point of time, amidst the public at a particular point of time. It is the supply of money. So however much amount of money has been supplied or is already in circulation is seen in terms of the legal definition of money. RBI publishes 5 alternative measures of money supply. What are the 5 alternative measures of money supply? This is something that needs to be seen. So let's have a look at the legal definitions of money in multiple forms. So reserve money is practically M0, followed by that is M1, M2, M3 and M4. M1, M2, M3, M4. The most liquid is M1. I repeat, the most liquid is M1 and the least liquid is M4. So narrow money, broad money, legal definitions of money. This is something that we have seen. This is something that we would be understanding. From M1 to M4, we have to specifically understand the basic aspect of money, right? Narrow money is M1, M2, broad money is M3, M4. Money creation by the banking system. So the amount of money in circulation in the banking system, the amount of money in circulation that we explicitly see, we are going to study about the key determinants of money supply or the factors affecting money supply. So we are going to study about the key determinants of money supply or the factors affecting money supply. The key determinants of money supply, how much money should be there in circulation or how much money should be there as a part of supply, that is something that needs to be seen. And then what are the factors that would be affecting money supply? So for simplicity's sake, we are going to take money supply as M1. How much money is in circulation? We are simply going to state a single term. It is called as M1. Now M1 is something that has been given as a part of money supply. So let's see what M1 is. M1 is currency in circulation. However much amount of currency is in circulation plus net demand deposit held by commercial banks. I repeat, demand deposits held by commercial banks. Demand deposits are deposits which are easily withdrawable. I repeat, demand deposits are easily withdrawable. There are 3 kinds of accounts in a bank. 3 तरह के अकाउंट्स होते हैं किसी भी बैंक में. पहला होता है करंट अकाउंट, दूसरा होता है सेविंग्स अकाउंट और तीसरा होता है फिक्स्ड डिपॉजिट अकाउंट. There are 3 types of accounts. So current account and savings account. Current account is the most liquid. Savings account is almost as liquid as current account. Fixed deposit is the least liquid. So current account and savings account have demand deposits. They have specifically demand deposits held by the commercial banks. So we are going to study about the key determinants of money supply or the factors affecting money supply. For simplicity's sake, we are going to take money supply as M1. Recall what M1 was, the one that definition we have already seen. The supply of money that is M1 would depend upon various factors such as actions of RBI, actions of commercial banks, preference of public to hold cash, etc. So supply of money would depend upon various factors. So it depends upon various factors such as actions of RBI, various factors such as actions of RBI, actions of commercial banks, preference of public to hold cash. The preference of public to hold cash, how much cash does public like to hold? So always remember that M1 is a kind of monetary aggregate which is the most liquid because it is in the form of cash or something that can be easily converted into cash. Demand deposit. Money is there in my savings account or my current account. I can simply go to the ATM and withdraw money. So preference of public to hold cash. That is something is reflective in M1. And M4 on the other hand, if you keep going down, M4 on the other hand is the least liquid. M1 is the most liquid, M4 is the least liquid. This is something that we see. These can be summarized by three key ratios that what we are going to see. The first one being currency deposit ratio, CDR, followed by that the second is reserve deposit ratio, RDR, and the third is high powered money, HPM. Currency deposit ratio, reserve deposit ratio, high powered money. We are looking at three things, and these are basically three ratios. So these three ratios we are going to understand the supply of money. The supply of money is going to be understood through these three ratios. Money creation by the banking system, currency deposit ratio. Currency deposit ratio means out of the total currency which is in circulation, what is the ratio of money which is deposited in the bank account. So let's say there is 100 in circulation, out of that 20 is in banks, 20 is in bank account. So that is something which is considered to be currency deposit ratio. Out of the total currency, how much is deposited in the bank account? It is the ratio of money held by the public in currency to that they hold in bank deposit. So ratio of money held by the public. Ratio of money held by the public in currency to that they hold in bank deposits. So if whatever money I have, irrespective of the amount, how much percentage do I hold in bank account versus how much do I spend, how much do I have in the form of cash. So CDR is equal to CU by DD, currency in circulation divided by money which is there in deposits, demand deposits, currency deposit ratio, CDR, currency deposit ratio. Followed by that, the second is reserve deposit ratio, RDR, reserve deposit ratio. It is the proportion of total deposits kept by commercial banks as reserves. So proportion of what? Total deposits kept by commercial banks. All the commercial banks, whatever is the proportion of total deposits which are kept by commercial banks as reserves is something which is coming as a part of reserve deposit ratio, RDR. So proportion of total deposits kept by commercial banks as reserves. So deposits kept as reserves divided by total deposits. Out of the total deposits, how much deposits have been kept as reserves? You may have seen that according to the monetary policy, there are certain things which have been explicitly stated that every bank, each commercial bank has to maintain certain reserves. And those reserves are a part of or as ratios of NDTL, net demand and time liabilities. So they are given as a part or in a form of CRR, cash reserve ratio, or SLR, statutory liquidity ratio. So two instruments of RDR, reserve deposit ratio. One of them is CRR and the second one is SLR. CRR is roughly around 5%, 4%, 5%. SLR is as high as 20%. So these are the two ratios. We will discuss this later when we start with monetary policy. But right now what you have to understand is reserve deposit ratio means the amount of deposits that banks have, a certain percentage of those deposits have to be given as reserves, which is why it is called as reserve deposit ratio, RDR. Proportion of total deposits kept by commercial banks as reserves, RDR or reserve deposit ratio. And the third one is high powered money. I repeat, high powered money. The total liability of RBI is called monetary base or high powered money. So total liability of Reserve Bank of India, whatever is the liability of Reserve Bank of India is called as monetary base or high powered money. What do we mean by liability of RBI? Liability of RBI means RBI provides funding to the government of India. On the other hand, RBI also provides government of India with this aspect for it to be able to be always be liquidity. It should be liquidity surplus or it should have surplus of cash. That is what many a time RBI ensures when it comes to government of India. On the other hand, RBI also borrows from the commercial banks. RBI is borrowing money from commercial banks. The rate of interest at which RBI borrows money from commercial banks is called as reverse repo rate. So that kind of money which is with the RBI is something which is an obligation on RBI or a liability of RBI. So it consists of currency in circulation and deposits held by government and commercial banks with RBI. Currency in circulation, whatever is the currency in circulation, and deposits held by government. Deposits which are held by government is a liability of RBI, held by government and commercial banks with RBI. So commercial banks deposit with RBI, government deposits with RBI is a liability on RBI, obligation of RBI to be discharged, and consists of currency in circulation and deposits. This is called as high powered money. So the first ratio is currency deposit ratio, followed by that reserve deposit ratio, and the third one is high powered money. Now you would be able to better understand and appreciate these things. Currency deposit ratio shows the amount of currency that people hold. The amount of currency that people hold as a proportion of aggregate deposits. Amount of currency that people hold as a proportion of aggregate deposits. What is the proportion of aggregate deposits that you need to understand? CDR, currency deposit ratio, is equal to currency in circulation divided by demand deposits. How much money, or what is the proportion, what is the ratio of money that I put in my bank versus the money that I hold in form of cash with me? It reflects people's preference for liquidity. What is the people's preference for liquidity we need to understand? That is something that is reflected. It is a behavioral parameter which itself depends on a wide-ranging factors such as agricultural seasons, festivals, etc. Behavioral parameter. So itself depends on a wide-ranging factors such as agricultural seasons, festivals, all of these things. Currency deposit ratio. Please remember currency deposit ratio in proper detail. Second is reserve deposit ratio, RDR, reserve deposit ratio. The proportion of total deposits, whatever are the total deposits kept by the banks, part of those deposits kept as reserves. The reserves are CRR, SLR. Primarily, these two are reserves for every commercial bank. Roughly, these two reserves, if we talk about today as we speak in 2019, it is 25%. Approximately, it would be a little less than 25%. So that is the money, approximately 1/4 of the total money is to be kept as reserves by the commercial banks. RDR, reserve deposit ratio, is equal to deposits kept as reserves divided by total deposits. The deposits which are kept as reserves divided by total deposits are specifically included in reserve deposit ratio. Banks always hold a part of money that people deposit as reserve money to maintain public confidence in banking system and avoid bank run. So maintain public confidence in the banking system and avoid a bank run is called as reserve deposit ratio. RDR, reserve deposit ratio. So a bank run occurs when a large number of customers of a bank or another financial institution withdraw their deposits simultaneously due to concerns about the bank's solvency. Bank run, to have the runs. To have the runs means, so it basically means that you have to have runs to be able to grab your money from the bank. It occurs when a large number of customers of a bank or another financial institution withdraw their deposits. Why are these deposits kept? And why are these deposits compulsorily to be kept with every bank? Why do banks have to keep these deposits? Because let's say if even half of the people go to the banks today itself as we speak to withdraw their money, where would the banks get that money from? Banks don't have that money. So then the reserves can be used. In times of crisis, the reserves can be used. That crisis probably would have occurred 25, 30 years back. That crisis this kind of crisis hasn't happened where people have approached the banks to withdraw their money. But if it happens in future, in order to maintain solvency of banks, the reserves are kept to reserve deposit ratio. So in any country, if the reserve deposit ratio is high, it means that the banks are required to keep high number of funds as reserves with them. They're required to keep that. They cannot help it. On the other hand, if it is low, it means that the country is confident enough that its economy is functioning well, where people would not approach the banks to be able to withdraw the money. Reserve deposit ratio. So, however, keeping reserves has an opportunity cost. That is, the reserve money could have been lent by the banks on which they would have earned interest. Remember one thing, that CRR and SLR don't give interest to banks. Banks उसपे कुछ कमाते नहीं हैं. So keeping reserves has an opportunity cost, that is the reserve money that could have been lent by the banks on which they would earn interest. This is why banks usually have a tendency to use up the reserves. Banks have a tendency to use up the reserves, using the reserves to make more profit but also taking more risk. to be able to make more profit, but also taking more risk. These are things which have been mentioned as a part of reserve deposit ratio. Therefore, RBI requires those banks to maintain minimum reserves to take care of the risk. So RBI, what does it require? It requires those banks to maintain minimum reserves. So those banks to maintain minimum reserves to take care of the risk. One has to take care of the risk, what risk is there, and one has to basically understand what is supposed to be done as a part of minimum reserves. RBI specifically uses two policy instruments to ensure that a healthy amount of reserves are being kept by the bank. Two policy instruments are there to ensure that a healthy amount of reserves, specific amount of reserves are being kept by the bank. This is something which RBI does through or by instating CRR and SLR as a compulsory thing to be maintained by each and every commercial bank. So RDR, cash reserve ratio. What is cash reserve ratio? You have to remember four things when it comes to cash reserve ratio. The first thing is that cash reserve ratio or the ratio is calculated on every bank's NDTL, net demand and time liabilities. It is supposed to be calculated on NDTL, on net demand and time liabilities. That is the first thing. Second thing is that commercial banks are not supposed to keep that as a reserve with themselves in their own premises. That money has to be kept in the RBI's premises. That is the second important thing that you have to remember. The third thing is that cash reserve ratio has to be kept in the form of cash. This is something which has been explicitly stated that you have to give cash. Whatever are your deposits at the end of the day, you have to give a percentage of that deposit in the form of cash in the RBI's premise, whether 4%, 5%, it is a blocked amount. It does not give any return to any bank, no returns to banks. That money is worthless and useless money for banks. It specifies the fraction of a bank's demand and time deposit that must be kept with the Reserve Bank of India. So rate keeps on fluctuating every 2 months. You can have a look at the updated rates, the updated monetary policy review. So it's cash reserve ratio. Followed by that, the second is statutory liquidity ratio. Statutory liquidity ratio is also supposed to be maintained by banks on NDTL. This is the first thing. The ratio is supposed to be maintained on NDTL, net demand and time liabilities. The difference between CRR SLR is that SLR can be maintained with the banks themselves. They can maintain it in their own premises. CRR has to be maintained in the RBI's premises. CRR has to be maintained in the form of cash. SLR has to be maintained in the form of cash as well as other things, in the form of government securities, in the form of gold. This is a highly important point. SLR can be maintained in other things, like SLR, if let's say SLR is 20%, you don't have 20% equivalent of cash. So what you do is you maintain it in the form of gold. You have gold of that value, or you have government securities of some value. It specifies the fraction of a bank's demand and time deposit that must be kept within the bank itself. Currently it is this, and it would keep on fluctuating. Statutory liquidity ratio. So remember these differences between cash reserve ratio and statutory liquidity ratio. The third is high powered money. The total liability of RBI, what RBI owes, it's the liability of RBI, is called monetary base or high powered money. It is called as monetary base and it is called as high powered money. It consists of currency in circulation and deposits held by government. Whatever currency is in circulation and whatever deposits are held by the government and commercial banks with Reserve Bank of India. So it consists of what? It consists of currency in circulation, deposits held by government, and commercial banks with RBI. All of these things are given as a part of this particular thing, high powered money. These items are claims that the general public, government, and commercial banks have on RBI and hence considered its liability. So items are claims that a general public, government, and commercial banks have on RBI and hence considered it's a liability. This is a liability that is being considered. Now we will understand how money is created using the concept of money multiplier, also called as the multiplier effect. So these items are claims that the general public, government, and commercial banks have on RBI. A specific effect that they have on RBI, and hence it is considered as a liability. So high-powered money where the liability is of RBI. So if you go on a holding a rupees 2000, if you go on holding a 2000 rupee note, and if you go holding a rupees 2000 note with you to the RBI, RBI would be obligated to exchange that banknote with banknotes of lower value or other coins which are legal tender under the Indian Coinage Act of 2011 of an equivalent amount. So 2000 rupee note, if a 2000 rupee note is damaged, if you have a look at the currency, it states bearer, you are a bearer of that note. And RBI is obliged to provide you in exchange of that note. It would exchange that note. Or it would give you a smaller denomination or equivalent smaller denominations of a 2000 rupee note. So as per section 26 of the RBI Act, the bank is liable to pay the value of banknote. Bank is liable to pay the value of banknote, high powered money. The money multiplier is the amount of money that banks generate with each dollar of reserves. Every dollar of reserves, the amount of money banks have generated. It's called as the money multiplier. The money multiplier is the ratio of deposits to reserves in the banking system. Ratio of deposits to reserves in the banking system is called as money multiplier. So it is the amount of money that banks generate with each dollar of reserves. Every dollar of reserves they have, they would want to multiply it. How do they multiply it? By lending and by further lending and more lending. That is the only way to multiply money, money multiplier effect. Once they lend money, that would further be lent to people or that would further be paid to people. So if an industry borrows, let's say 1000 crores, it would be spending on 10 different activities, and those 10 people would be further spending it on 100 different activities. So money keeps on multiplying. This is called as a multiplier effect. So you guys pay to Unacademy. Unacademy pays to educators like us. We further pay to different people. So this is something which is called as a money multiplier effect. High powered money, let's take an example, it will be more clear to you. Imagine that you are the chairman of SBI, State Bank of India. This is the symbol of SBI. An RDR of 10% has been warranted by RBI. RDR, reserve deposit ratio of 10% has been warranted by RBI. Hence, it is considered to be a specification. This means that for every rupee 1 of deposits, you can only lend 90 paise and keep the remaining 10 paise as reserves. So it means that for every 1 rupee of deposit, you can only lend 90 paise, which means that 10% has to be put as a reserve, which is a mandate which you have to follow, has been stated by Reserve Bank of India. Total value of SBI's deposit is rupees 100,000. So total value of SBI's deposit is rupees 100,000. Given that you want to maximize SBI's profits, you loan out the remaining rupees 90,000 while keeping 10,000 as reserves. So that is something that you give. So SBI has given you 90,000 rupees as a loan. Congratulations, you have gotten a loan. Whatever SBI had, everything has been given to you. You've just increased the supply of money. And as soon as you get that money, you've just increased the supply of money from rupees 1 lakh to 1,90,000. So 1 lakh of deposits that SBI had, it had further lent 90,000. Supply of money increased to 1,90,000. You have got 90,000 rupees. Your depositors, so this is how you did it. Let's understand. Your depositors still have rupees 100,000 with you. Your depositors still have 100,000 with you, but only on paper. It's only on paper. The depositors have money only on paper. Banks are further lending it. So they are multiplying money. They can come in any time and get their money. So you can go to the bank, you can withdraw money. However, since not everyone wants their money at the same time, you don't expect that all account holders of an aggregate value of 1 lakh would come on the same day. Probably 10% would come, 15% would come, 20% would come. So they would want their money at the same time. Your reserves of rupees 10,000 will cover the normal demand for withdrawals. So they would cover the normal demand for withdrawals, which is absolutely true. Simultaneously, you have been given 90,000 rupees as loans and you have distributed rupees 90,000 as loans. The borrowers will spend that money on various items. So whoever has borrowed that money would be spending money to pay salaries, to install new machinery, to buy new raw materials. Sellers who receive the loaned money in exchange for their goods will deposit their revenue in banks. Then the banks will turn around and loan out another 90% of that rupees 90,000 and the cycle will start all over again. The cycle would keep on going, it would keep on existing. And this is something which is called as high powered money because this would keep on multiplying. which is why in a healthy economy it is important for us to deposit money in banks, for banks to be able to further loan out money to people, and banks to be able to recover money more importantly. The problem in India is the first two steps are happening, but the third step is not happening, where people are not paying back to the banks, or banks are not recovering because of whatever reason. So whether we see the case of PNB, whether we see the case of PMC, there have been multiple issues. Money multiplier concept basically states that increase in money supply as a result of injection of high-powered money by Reserve Bank of India is greater than actual injection of high-powered money by Reserve Bank of India. So increase in money supply as a result of injection of HPM by RBI. Injection of what? High-powered money by Reserve Bank of India. It is greater than actual injection of high-powered money by Reserve Bank of India. This is something which we explicitly see because Reserve Bank of India can just do as much. It cannot be granting loans to every single industry in this country. That has to be done by banks. So injection of HPM by RBI is greater than actual injection of HPM by RBI. So it's better that increase in money supply as a result of injection of high-powered money by RBI is more important. So whatever the RBI has stated, that is something that should be told to the people, or that should be explicitly stated to the account holders, or let's say to the banks, and banks would further lend money. So money multiplier is therefore defined as the ratio of the stock of money to the stock of high-powered money in an economy. So ratio of the stock of money, how much money do you have, stock of money, to the stock of high-powered money in an economy is called as money multiplier. How much money are you multiplying? How much money do I have in stock? And how much money would stock of high-powered money in an economy, how much of it would keep on increasing? That is something that we have to understand. It is inversely proportional to RDR, reserve deposit ratio. That is, higher the reserves kept by banks, lower would be the money multiplier, and vice versa. Higher the reserves which are kept by the banks, lower would be the money multiplier. So if you keep higher reserves, obviously reserves are kept for a purpose of not being lent further, So money multiplier would be less. On the other hand, if it is lower, money multiplier would be high. So it is inversely proportional to RDR. ये ध्यान रखिएगा, money multiplier is equal to 1 divided by RDR. Supply of money, RBI and its functions. Let's learn about the Reserve Bank of India and what are the various functions it performs. Reserve Bank of India is the central bank of India, set up in 1935 by virtue of RBI Act 1934. So it is set up in 1935 by virtue of RBI Act of 1934. Formation of RBI was recommended by the Hilton Young Commission, and it first started with a share capital of rupees 5 crores. So formation of Reserve Bank of India was recommended by the Hilton Young Commission, and it first started with a share capital of rupees 5 crores. This is something that was stated. We are talking of Hilton Young Commission, which had given its report way back in 1928. RBI Act came about in 1934. An institution started functioning from the 1st of April 1935. So at that time, 5 crore for a bank was a huge amount. It was nationalized, which means it came under the control of Government of India in the year 1949 and is currently fully owned by Government of India. So RBI is a fully government-owned institution and its functions. So Reserve Bank of India and its functions. What are the various functions of the Reserve Bank of India? First, it is the sole authority to issue currency. The sole single authority to issue currency is RBI. RBI के सिवा कोई दूसरी authority currency issue नहीं कर सकती. It is the sole authority to issue currency. Second is, it is acting as a banker's bank. Banker's bank. It is a banker for commercial banks. SBI, PNB, Canara, Vijaya. For all of these banks, it is acting as a banker's bank. It is acting as a banker. वो banker है और ये bank है. तो I mean, if you want to lend to the RBI, you can. If you want to borrow from the RBI, you can. You have to maintain reserves with RBI. It is acting as a banker's bank. Third is lender of last resort. Lender of last resort, RBI is a lender of last resort. When commercial banks have nowhere to go to, they go to the Reserve Bank of India. It is a lender of last resort. Fourth is, it is acting as a government's bank, which means it is, so there are two things that you have to remember, and you can remember that in sync. That RBI is a banker to commercial banks, RBI is a banker to the government of India. गवर्नमेंट ऑफ इंडिया के लिए बैंकर भी रिजर्व बैंक ऑफ इंडिया है. Reserve Bank of India is, as it is a central bank of India, it would receive everything from abroad. Like for example, if the government of India borrows $1 billion from IMF or the World Bank, it would not be given to the government of India. It would come to the Reserve Bank of India, and Reserve Bank of India would disburse the money to the government of India. Hence, the banker of government, and the repayments would also be done through RBI. Repayments of installments, interest, principal amount, that would also be done through Reserve Bank of India, government's bank. Followed by that is that it is a custodian of forex reserves. It is a custodian of foreign exchange reserves. It has the custody of forex reserves. It formulates monetary policy. It formulates monetary policy. It gives a review of monetary policy on a bi-monthly basis, and through monetary policy, it tries to control the credit. Rather, we should say it tries to regulate the rate of inflation. I repeat, it tries to regulate the rate of inflation. This is something that has been explicitly stated by the Reserve Bank of India. After that is that it is a regulator of financial system. I repeat, it is a regulator of financial system. It is regulating the entire financial system. And finally, it is managing Foreign Exchange Management Act. It is managing Foreign Exchange Management Act, FEMA. FEMA is being managed. So it is the sole authority to issue currency. It is acting as a banker to the bank. It is acting as a banker to the government. It is a lender of last resort, custodian of foreign exchange reserves. It is formulating monetary policy. It is a regulator of financial system, and it manages FEMA. So these are the functions of Reserve Bank of India. Reserve Bank of India के ये सारे functions हैं. Now we would understand these functions in proper detail. Listen to it one by one. RBI is the nation's sole note issuing authority along with the Government of India. It is responsible for the design, production, overall management of the nation's currency. Everything happens within the jurisdiction of Reserve Bank of India, whether it is the design or the production and overall management of nation's currency. With the goal of ensuring an adequate supply, the goal is to ensure adequate supply of clean and genuine notes. This is the sole authority to issue currency. The first thing. Second is it is acting as a banker to the bank as well as a banker to the Government of India. As a banker of banks, Reserve Bank of India enables swift clearing and settlements of interbank transactions. Swift clearing of settlements. This is something that the RBI ensures. Clearing and settlements of the interbank transactions. This is what is happening. Followed by that, the second is it provides efficient means of fund transfer for all the banks. Efficient means of fund transfer. How the funds are being transferred for all the banks is being taken up within the Reserve Bank of India. It is providing efficient means of funds transfer. The third is it enables banks to maintain their accounts with RBI for statutory reserve requirements and maintenance of transaction balances. So enables banks to maintain their accounts with RBI. So what is happening? It is enabling the banks. You have to enable the banks to maintain your accounts with the Reserve Bank of India for statutory reserve requirements, whatever are they, like for example CRR, SLR is a statutory reserve requirement, and maintenance of transaction balances, whatever balances one has to maintain. And lastly, it is acting as a lender of last resort. So when nobody comes to the rescue of any bank, RBI does. What RBI does is RBI either helps the merger of that bank with some other bank. It would ask, like for example SBI, to take over the operations and management of Oriental Bank of Commerce to basically pull it out of losses or pull it out of the crisis situation. It can do the same for PMC, Punjab and Maharashtra Bank. So all of these things can be done. As a banker of banks, Reserve Bank of India, it would take into account all these things, RBI and its functions. The third is it is acting as a lender of last resort, LOLR, lender of last resort. RBI comes to the rescue of a bank that is solvent but faces temporary liquidity problems. So it is solvent but faces temporary liquidity problems by supplying it with much needed liquidity when no one else is willing to extend credit to that bank. So RBI comes to the rescue of a bank. RBI is doing what? It is coming to the rescue of a bank that is solvent but faces temporary liquidity problems, liquidity crunch, that it doesn't have money right now. by supplying it with much needed liquidity when no one else is willing to extend credit to that bank. No one else is willing to extend credit to that bank. RBI extends this facility to protect the interest of the depositors of the bank and to prevent possible failure of the bank. Highly, highly important. If possibly you come to know that the bank is about to fail, why would you allow a bank to fail? Which in turn, so you would come out with a recovery plan for the bank, which in turn may also affect other banks and institutions and can have an adverse impact on financial stability and thus on the economy. So, in order to save the economy and other banks, and especially the account holders, you have to protect the interest of the depositors of the bank to prevent a possible failure of the bank. This is what the RBI does, lender of last resort. Government's bank. It is acting as a banker to the government of India. So, as a banker of government, RBI performs the following functions. First is it is lending to the government. It gives money to the government, it lends to the government. Second, it raises loans from various sources on behalf of the government. It raises loans from various sources on behalf of the government. Loans को raise करो अलग अलग sources से on behalf of the government. It raises loans. Second. Third is it acts as an agent of government with respect to international bodies such as IMF and World Bank. It acts as an agent of the government. This is what I had explained. So look, if it has to act as a banker for anyone, so all the activities that a banker would do, RBI would do. Like my banker, if I write a check in someone's favor, then the money would be paid by my bank. If I get a check from someone, I give my account number, I deposit the check in the bank. It would come in my bank account. My credit cards, debit cards are linked to my bank account. So everything, banker is acting, so it is a bank branch which is acting as a banker for me. Similarly, the Reserve Bank of India is acting as a banker to the government of India. RBI performs the following functions. It lends to the government. It raises loans from various sources on behalf of the government. It acts as an agent of government with respect to international bodies such as IMF and World Bank. This is the government's bank. Reserve Bank of India and its functions. What are the functions of Reserve Bank of India? It is acting as a custodian of India's forex reserves. The sole custodian of foreign exchange reserves in India is the Reserve Bank of India. इस चीज़ को ध्यान रखिएगा. RBI's forex reserves comprise the following. The first is foreign currency assets. The second is gold. The third is special drawing rights. And the fourth is reserve tranche position. This is something that has been asked in prelims 2-3 times. That which of the following comprise of forex reserves? Forex reserves doesn't only mean foreign currency or bonds denominated in foreign currency. It is a much wider interpretation. So have a look at the definition of forex reserves. Foreign exchange reserves are reserve assets held by a central bank in foreign currencies. They are reserve assets which are held by a central bank in foreign currencies, used to back liabilities on their own issued currency as well as to influence monetary policy. This is what a forex reserves does. So forex reserves are reserve assets held by a central bank in foreign currencies. Whatever is held by a central bank in foreign currency used to back liabilities on their own issued currency as well as to influence monetary policy. This is what forex reserves do. Foreign currency assets, which means that foreign currency denominated in any of, you can say, denominated in any of the currencies, global currencies, dollar, pound, dinar, euro, whatever. Gold is used for backing foreign currencies. Many a time it is used for backing foreign currencies. Third is special drawing rights. Special drawing right is basically, in order to understand it simply, I would tell you that it is a currency of the IMF. It is a currency of the International Monetary Fund. So if I go to the International Monetary Fund representing India that you need to support us to the tune of $10 billion. We are falling short of $10 billion. We don't have money to pay for the oil imports. So what would they do? They would not give me $10 billion. They would instead give me $10 billion worth of special drawing rights. So special drawing right is a currency which is of the IMF, International Monetary Fund. It would grant that currency to me in terms of SDR. SDR then I can use to pledge SDR with some other third country. Let's say I would go to China. I would tell them that you take these $10 billion worth of SDR and give me that liquid cash so that I'm able to use that cash. I would pay the interest to China, and further differential interest I would pay to the World Bank, sorry, IMF. So this is how special drawing rights work. And followed to special drawing rights is the fourth thing, which is called as reserve tranche position, RTP. Each member of the IMF is assigned a quota. Each member of the IMF International Monetary Fund is given a quota. It is assigned a quota, part of which is payable in SDR and part in the member's own currency. Member's own currency, it is paid in part and payable in SDR. The difference between a member's quota and the IMF's holdings of its currency is a country's reserve tranche position. What is a member's quota? Let's say India's quota in IMF is to the tune of 2.3%. So we can borrow from the IMF to the tune of a quota. That is what we can do. US would have a much higher quota. Russia would have a high quota. Germany would have a high quota. So the borrowing from IMF is not standard or is not abstract. It is not unlimited. It can be done on the basis of the limited quota you have. So the difference between a member's quota and the IMF's holding of its currency is a country's reserve tranche position. So this is how foreign currency or forex reserves included within this aspect. Yes. Followed by it is a formulation of monetary policy or controller of credit. Monetary policy, it refers to the policy of the central bank with regard to the use of monetary policy instruments. Monetary policy instruments under its control to achieve the goals specified in the Reserve Bank of India Act. So when we say that the goals have been specified in the Reserve Bank of India Act, what is it that we are talking about? Monetary policy or the controller of credit. When RBI comes with its monetary policy review, it regulates everything. Regulation of everything means increase or decrease, tweaking in the key rates, rate of interest in terms of repo rate, in terms of reverse repo rate, in terms of bank rate, in terms of open market operations, in terms of CRR, in terms of SLR. This is what is done in order to tweak the rates. So RBI is vested with the responsibility of conducting monetary policy as mandated under the RBI Act of 1934. So it is vested with the responsibility of conducting monetary policy. Conducting what? Monetary policy as mandated under the RBI Act of 1934. RBI adopts two types of measures in order to control credit. Two types of measures in order to control credit. You are wanting to control credit and implementing the monetary policy. Quantitative measures and qualitative measures. These are two types of instruments which are in the hands of Reserve Bank of India to be able to control, or rather to be able to regulate credit in the economy. That is what is done. So we specifically see the quantitative measures which are used to directly impact the quantity of money supply. Reserve Bank of India and its functions. Formulation of monetary policy or controller of credit. There are four quantitative measures that RBI uses as given below. CRR plus SLR. These are the two reserve ratios. Bank rate is the rate at which RBI lends to commercial banks for a longer term, for a longer period at a rate of interest. That rate of interest is called as bank rate. Then comes repo rate plus reverse repo rate. Repo rate is also the same rate where RBI lends to commercial banks at a certain rate of interest, but the tenure is short term, for a short term period. Repo rate plus reverse repo rate is reverse of repo rate, where commercial banks are lending to the RBI. So commercial banks are lending to the RBI at a certain rate of interest. Whatever they take, it is considered to be reverse repo rate. And then open market operations. Open market operations is an activity that is being conducted by the RBI through sale and purchase of government securities. Sale and purchase of government securities in the RBI premises, or you can say through RBI with each and every central bank, is conducted or is called as open market operations. You may have heard of the gilt markets. There are certain markets by the name of gilt markets. So when we say that gilt markets are specifically given, gilt markets are made, or gilt divisions of each and every bank is made for this very purpose to understand the trading which is supposed to take place. So gilt market is earmarked for the purposes of purchase and sale of government securities by each and every bank. That division is called as gilt, GILT. कभी देखिएगा पंजाब नेशनल बैंक, PNB gilt, SBI gilt, etc. etc. The big branches of these banks would have a separate division in that branch by the name of gilt division. All right. So we'll continue with these, the formulation of monetary policy, and we'll continue with CRR, SLR, and understanding in our next class. Thank you so much for joining me for the session, everyone. I hope you enjoyed the session. So we have discussed this in proper detail, and I hope that you have enjoyed the session. We are on chapter 3. We'll be continuing in our next class. All right. Bye, everyone. Take care. All the best. Guys, you can subscribe for my courses on unacademy.com/plus by using my name as the referral code. My name is Ayussh Sanghi, AYUSSHSANGHI. When you use my name as the referral code, you'll be eligible to get a 10% discount on your subscription amount. So it's a very good bargain, it's a very good deal, and it would unlock all the educators for you at one go. So guys, see you in the class very soon. Bye. Take care.